While everyone is worried about a recession, the real bomb is ticking inside the skyscrapers of New York and San Francisco, and the timer stops in 2026. According to new data, a staggering $1.5 trillion of commercial real estate debt is coming due by the end of 2026. This is what Wall Street calls a maturity wall. But in reality, it is a cliff, and thousands of landlords are about to drive right off the edge. The problem is simple. Nobody is going back to the office. San Francisco has hit a record vacancy rate of 27.7%. That is nearly 1 in 3 offices sitting empty, collecting dust instead of rent. Even in Manhattan, vacancy is at historic highs. Morgan Stanley has issued a brutal warning. They predict commercial property prices could crash by 40%. To put that in perspective, that is a worse crash than the 2008 financial crisis. But who holds the bag when these landlords default? It's not the big banks like J.P. Morgan. It's your local bank. Small and regional banks hold 70% of all this toxic commercial debt. These banks have less than $1 billion in assets. One major default could wipe out their entire equity. We are looking at a potential wave of bank failures that makes Silicon Valley Bank look like a rehearsal. In 2008, the problem was bad loans to homeowners. In 2026, the problem is a structural shift in how humans work. Remote work isn't going away, and high interest rates make refinancing this $1.5 trillion debt mathematically impossible. Goldman Sachs warns that functional obsolescence is making billions of dollars of real estate worthless overnight. If these regional banks fail, the contagion spreads to the entire economy. Credit dries up, small businesses die, jobs are lost. The real estate crash of 2026 isn't just about empty buildings. It's about the solvency of the American banking system. We will be tracking every bank failure here. Subscribe now so you know where to move your money before the doors close.